Mr. Dylan McCatherine in the house. How we doing?
Very well, very well.
So Dylan McCatherine is lender extraordinaire in the Denver metro area. We have done a ton of business together, and he continues to be my number one absolute boss lender with the number of creative solutions that he always brings to the table. So I thought today would be a really interesting conversation with kind of a talk to the expert situation here after Realtor.com released something that caught my attention recently. 10 things most home buyers get wrong about getting a mortgage today. So we're going to cover that here in a bit. But Dylan, let's hear who are you, man? What's going on?
Yeah. Well, thanks for having me. I'm a senior loan officer here in Denver, and it's been a pretty fun little environment to tackle over the past 2 years, and especially, where people's heads are at. You have to come up with creative solutions and have to know how to talk to people in a way that they can understand that, hey, is there a risk here? Or, hey, is there not a risk here? And what's the best decision for me? So I've actually really liked playing in this market because it's separated the agents that are giving the best advice. It's separated the lenders that are giving the best advice and the people that are, I think, truly looking out for their clients versus just, hey, here's a number on a screen and, I've got 50 people behind you because everyone's trying to refinance. So it's been a totally different landscape. So I think conversations like this are really important because it's really important for people in my shoes and people in your shoes, Jason, to have a conversation, and within that first conversation, give the advice that's going to put that person on the right path. Or it could just totally derail their success, their potential success to buy a house and build some wealth. So
that is so true. And I have to say that every time someone gets the chance to chat with you, they leave that conversation in feedback back to me that says, that was the most clear. I feel more clear now than I've ever felt about the numbers, and I can now go out and confidently shop. So I got to applaud you for the process that you have. It is very good.
Yeah. My favorite thing to tell people is unfortunately, what I do is not the sexy part of buying a house. I think it is, but it's not for them. So if we can get the non-sexy part out of the way early on, and you can actually go focus on walking in the house and knowing it's going to work before you ever step foot in it, it makes the whole process more enjoyable. So thank you.
So true. Yeah. And I don't like staring at spreadsheets quite as much as you do. So thank you.
I love it.
So let's, the first thing that Realtor.com says here, and again, the title of this article, 10 things most home buyers get wrong about getting a mortgage today. This was published on October 16th. And, number one, they say focusing too much on the interest rate. And right now, interest rate is all over headlines. Affordability is incredibly squeezed. But why are they saying that focusing too much on the rate would be like something a buyer gets wrong?
Yeah, I think this gets back into being able to give people the right advice and the right strategy. So, it's important. The interest rate is important. It's the reason that we're in the market that we're in, is the fact that interest rates are high and people need to pay attention to that, and it's having an effect on the economy, right? But I think what Realtor.com gets right here is the fact that often people think the lowest interest rate that I get presented on a piece of paper or an email or whatever is the best deal, when in fact that's not the case. So for example, here, I got an email the other day from one of our branch managers here at my company, Spire Financial, and they had received a disclosure from another lender that this person came to them and said, hey, we got offered a 6.75% interest rate on this $500,000 house, which is unfortunate. 6.75 actually sounds really good right now because rates are closer to 8. And they were like, how can you beat this? Turns out that person was being charged on a $500,000 house $35,000 in discount points and fees to get there. And they didn't have a good understanding of what that meant. So you start breaking it down, and this person would have only saved $400, $500 by spending $35,000. The break even on that is it's terrible. You know, you just
terrible.
divide those two numbers into each other. It's what is that number? It's probably something like 7 years to break even on spending that money. Yeah. The chance that we're not going to see improvement in rates and see refinances before then is really low. So that person got the wrong advice. You shouldn't just spend money on a lower rate just to get the lowest rate. And it goes into further strategy as well. You know, sometimes taking the higher rate, but letting the seller pay for other ways that you can save on your monthly payment is really important. Yeah. But you leave more money in your pocket and you have a better reserve. Yeah. Maybe the higher rate is better for some people because now they have better emergency fund because they're taking on a higher payment. And maybe it's more comfortable for them to have 10 grand extra in the bank than save an extra $80 on their monthly payment. And I would argue most people would probably feel that way.
Absolutely. And, you know, another interesting thing is like, there has to be a disclaimer when they see some amazing rate through, you know, one of these maybe like giant online corporate lenders. You know, if you see a 6.5, your alarm bell should be going off because that's not the market rate right now. So look for that asterisk and then scroll down to the bottom of the page or whatever. And then, you know, you might know this, like, do they have to actually disclose the points that are required to get this advertised rate somewhere on the page?
Yeah, legally they do. Yeah. We all agree to that when we get our license. Right. And it's somewhere. It's probably hidden.
Right. It's like white on white text.
Yeah.
White background. Yeah.
Yeah. And I mean, one place I usually show my clients to compare us to, because I think that you should have this certain degree of just letting them know where you sit in the market. Mm-hmm. We're not going to be the cheapest person, nor do we want to be because of the advice we get, but we want to be fairly priced because at the same time, like I mentioned, interest rate is important. So I'll show people Rocket Mortgage and how to decipher what's on that page because they explicitly tell you what their rates are, but no one knows how to interpret it unless they've been walked through it. And then all of a sudden they have a better temperature check on the market. They know how to read things if they go Google what our interest rates are today. And those people tend to not leave us, even if we are slightly more expensive, because the advice that we've given and the strategy we've given. That I think it is often the lender's role to be as part of the wealth building journey as a financial advisor, as a CPA. So you should trust that person enough and be willing to spend some money on it to end up 5 years down the line in a better position.
For sure.
Yeah. Go ahead.
And also, you know, I think, and we can definitely move on from this, and we're spending a lot of time on this first one, but it's so relevant right now.
It's a lot to unpack.
Yeah. And it's also, it seems like the rate is the rate set by the market, right? So it's not like you can, as a lender, say like, you know what, today I'm going to offer 4% and just get all the business. It doesn't work that way because it's a market. So I suppose that, you know, maybe if people are starting to shop for, you know, an eighth of a point difference here or there, like this level of service that comes with that and level of headache or lack of headache that comes with that should be considered, is kind of what you're saying too, right?
100%. Yeah. Every lender knows what the raw price is for that day.
Right.
It's simply based on the market. You're totally right. The people that are offering the lowest rate possible and the cheapest rate possible often come with the lowest level of service. You know, if I was planning a wedding, would I plan a wedding with somebody that's really, really dialed into the process and gives me every bit of information I know? They're really on top of it. And then would I abandon that person on the wedding day? Like, hey, by the way, I'm going to not pay you, and my buddy's going to come in and drive everything that we talk about. We paid all the vendors, so they're going to keep everything in line today. Let us get to the finish line without chaos.
Yeah.
I think that's a pretty good analogy for lending, and for a real estate agent. You wouldn't abandon someone that's been guiding you on the process for a long time right at the last moment. And it's, right. You see that. You see people only play the role of trying to swoop in at the end and be the lowest price. But, you know, sometimes the lowest price is just a number on a piece of paper. But if it doesn't get you through the closing table, you don't actually get a house. So
that is a fact. If you don't get a house, it was all for naught.
Right? Yeah, it's just a number. And yeah, numbers don't really serve you anyway in that way.
Cool. So moving on to number 2, assuming you need a 20% down payment. This is huge. When I bought my first house, 15% down, and I actually was able to buy all of my PMI which is something that nobody loves to pay, but I bought all of it upfront in bulk. And I actually didn't even know that was an option until I was about to close. And I obviously took that option because it enabled me to reserve some funds for improvements, which took me 2 years to actually do, which is a whole nother thing. But, a lot of people think to themselves, maybe because it was at the dinner table, family discussion, you got to save 20% because you don't want to pay PMI. Why is that something that buyers should be maybe breaking that belief of?
Yeah, I mean, it's economies of scale. When you boil it all down, our parents did save 20%. The house I'm paying $500,000 for also cost $100,000 then.
Right.
It takes a lot longer to save $100,000 than it does 20. So
right.
Even with today's wages, so it's a great thought. If somebody can get to 20%, beautiful. There are advantages to that in pricing. There are advantages to that with no mortgage insurance. But if somebody is saving up for a year, 2 years, 3 years, and they're at 10% down, there's a few implications of getting to 20%. It's going to take probably a few more years based on this. What is going to happen to property value in the next few years? We don't know. It could improve. You might lose out on some equity in that case. So the other implication of this is if I save 20%, that was my number, and I spend all of it, have I really made it the best financial decision that's going to give me a big enough safety net? Mm-hmm. Am I going to have the reserves necessary to feel comfortable with a payment? Right. I think especially right now when monthly payments are a little bit higher, it's kind of staggering when you show someone, hey, this extra 5% down, that could probably be your emergency fund. Mm-hmm. Let's call that $25,000. Yep. That $25,000 that you're not going to put down is only going to change your monthly payment. Let's say $175, $200. So is it more important you have $25,000 in the bank? Or is it more important to you to have a $200 less monthly payment that we're probably going to get relief on in the future once we get out of this interest rate cycle?
Have that cushion, man. Keep it in the bank for the emergency, for whatever you need. Yeah,
I think so. And I get in the room with financial advisors a lot when we're going through the discussion of what we think we should truly put down. And people will loop me in with them. And the conversation often goes to A, how can I have a bigger emergency fund? But also B, let's not keep our eye off of diversifying our investments. Sure. Real estate is amazing. It's made more people rich than probably anything else. But we're in an economy where it probably makes sense to invest elsewhere also. So if we can continue to diversify, and I bet your financial advisor, regardless of who that person is, can show you the power of that. So 20% is fantastic. It will give you benefits. Yeah. It's often not right for people in our generation for the first one. Yeah. Because it often sucks all their assets and doesn't give them enough safety net. And especially when rates are high, the ability to feel comfortable with a higher payment, the ability to know that you have a fallback plan if things go wrong is often, in my experience, way, way more powerful, way more comforting than having a slightly lower monthly payment.
For sure. Totally agree with that. You did mention something briefly early on in this, when we started this particular part here, and it's chasing the values, and appreciation has slowed down. It should be noted that appreciation has not gone the other direction. There's been very little depreciation, at least in the Denver metro. But to chase an appreciating market, 20% gets larger by the same ratio that values are going up. So we saw 20% appreciation in 2020, 19 and 22, or in 21, and then the first half of 22, the full year shook out to be about 10. So 20% appreciation on a $500,000 house, it's $100,000. So chasing that, and your savings rate probably doesn't increase at the same rate of home values appreciating. Now, of course, there are always variations in that, but chasing 20 seems like a pipe dream especially in a rapid appreciating market.
And this gets into as well, $100,000 sitting in my bank account, if I do nothing with it and it doesn't appreciate and I'm not investing it and I'm just sitting it there, it depreciates. Inflation has its way with it, right? Versus that $100,000 in a house, that $100,000 in stocks, whatever you're investing with, use your money to make money. Yeah. That money works with the economy and inflates with it. So I think that's really important. And people, so you're not only chasing the value. Yeah. your money's also becoming worth less at the same time. So it's a hard nut to crack, but ultimately, if you have 5% down and you have 10% down, maybe it makes sense. You have to look at it with someone, and maybe you can get to a payment and a house value where you're comfortable, and maybe you can't, and you do need to save longer. There's not an answer for
analysis that I know you do. It's like, here's what the all-in situation looks like at 10% down, 15 and 20 for the person who has that ability, right? And they can make the choice, right? Which door do you want to walk through?
Yeah. And show it to the people around you. Show it to the people within your inner circle that you trust. Show your parents, like, hey, Dad, should I have this 100K in the bank as a safety net being invested, or should I put it all into the house?
Right.
When they see it side by side, they may be like, hey, 100 grand of safety net is pretty sweet. So
totally.
All right.
Well, I feel solid about that. Number 3, assuming you can get a loan instantly. I know you're going to have some thoughts on this. Tell me what Realtor.com is referring to here.
Yeah, I think a lot of people, understandably, are going to sit on Zillow and have these dreams, and everyone's thinking about buying their first house or their second house or whatever. Especially the first time, these people might think, oh, I have a good job, I can afford this house. But they don't have an understanding what the mortgage process looks like, you know, what a debt to income ratio is, how is a qualification completed. So they might go see that house as an open house and try to make an offer. And if that house has a tension on it already and another offer's coming in, they may not have time to get pre-approved. It might take a day or two. There might be something that has to be reconciled.
Right.
And maybe they lose that house because of that. So we've got into it. The prep work is so important. It's important for knowing what qualification looks like. Like, what are closing costs? Well, how does a payment build up? But also, what do I need to make an offer? And it can happen quickly. I'll get you pre-approved in an hour, Jason. But
and
if we're up against another offer and we don't have an hour, then
you've done that for sure.
You're SOL. So, and you just need to be prepared. This is not a light decision, and it goes into every facet of it. And this is one of them. Talk to someone soon.
That's part of my pre-qualification process, right? So if someone is in stage 0, which is, we saw this house on Zillow, we really like it. Do you think we could go see it? Yeah. And, you know, if it's just a really interesting house that's completely out of budget and it's never going to be, you know, a dream for that person, like, hey, sure, that's just like a fun thing to go see the house. Sure. But if they're actually serious about buying, and something that you and I have done quite a bit of is TBD underwriting. And maybe you guys have a different name for it, but at the end of the day, it's like, hey, this person has been fully vetted, you know, credit's been checked, assets have been verified, employment's been verified, everything looks good. So all you're missing is the contract, which then once you have that in hand, the whole process can go very quick, including the appraisal, the inspection, and we can even close in as little as 15 days. It's not exactly comfortable for your underwriting team, but you guys have done it before. So
yeah. And I mean, I did one in 12 in Texas the other day. So it's not comfortable, but if we do the work up front, it becomes comfortable because all we need is an address at that point. And I think it's funny that also plays into like be represented on the agent side, because you shouldn't show up to be ready to make an offer and not be prepared as well. Like all this was into be prepared, do your homework early, and you're going to make a better decision. You're going to know why you don't need the lowest interest rate, or you're going to know how to take advantage of the market in its current state. And it all plays into just being more prepared, I think. And the most prepared buyer is the buyer that's going to have the most success and wake up in 3 years and be like, wow, I made a great decision, versus just spraying and praying or just hoping that it works out and not having enough people in their corner to really bounce all those ideas off of each other and get to the offer table and feel very confident.
That's a clip right there, and that's gonna be posted to social media because that's exactly correct. All right, so moving on. You good to move number 4?
Yeah, let's do it. Well, Boogie, these next ones are easier to get through quickly.
No, it's all good. Yeah. Thinking pre-qualification means you're approved for the loan. So, Dylan, tell me, what is the difference between pre-qualified and approved?
Yeah, so pre-qualified, what I most often run into this with is somebody goes on to some lender's website. Let's call it Chase. Chase is a very popular one because a lot of people pay with Chase. They plug in, here's my current income, Here's the number, the number on the purchase price that I want to buy, and here's how much money I want to put down. And all Chase knows is, what your credit card's debt looks like, and maybe they have some insight into your credit report from the past, but they don't know exactly what your credit score is. They don't know how many people are going to be on that loan. They haven't ran your weird income past an underwriter. They don't know how it's broken out. So they may give you this thing on the screen that says, yay, you're pre-qualified. You can buy this house.
Sure.
And it's not uncommon for those pre-quals to come back and you're like, actually X, Y, and Z are things we're going to have to navigate to make sure you're actually qualified for this. So let me run this past my underwriter. So the difference between a pre-qual is you're just sharing minor details. You're not bouncing it against the regulations, which are a rather large stack that we have to use to qualify someone truly and finish a loan. Yeah. While pre-approval goes that next step. Pre-approval is where you as a buyer can have your agent go on your behalf and say, hey, listing agent, I want to buy this house, or my client does, and they're totally approved for this. Pre-approval is the one that carries weight because that would be me looking at your credit, me gathering income documents, me working through your tax returns, doing all the things we need to do to reconcile your liabilities and your income. And if you get that pre-approval letter and we've given it to you responsibly, you're going to get to the closing table. And now I can call a listing agent and tell them that, and your offer just became that much more powerful. And if someone comes to them with a pre-qual, you're going to win every single time.
Yep. I have been on both the buyer representation and the seller representation side of this. And when I'm representing a seller, you're making these phone calls to the lenders of the buyers that have made offers on your listing. And, I'm oftentimes, the question I ask is like, hey, with your reputation being on the line here, how well are these people approved? And sometimes the answer has been, okay, I'll be upfront with you. They're probably going to be fine, but we haven't verified a lot of their assets or their income. That was like, okay, so they've been pre-qualified. Yes, correct. Versus a pre-approval, like there's nothing that could kill this deal except for them losing their job.
Exactly.
That is a confident conversation, and I feel comfortable advising my sellers to get that kind of an offer.
And that's powerful, right? I talk about and think about this often because I fit into this side where I'm always with the buyer. The listing agent's job is to be able to take that offer, take what's been packaged up for them, and present it as something that's bomb-proof. They're basically selling it to their client. That's a weird thought, right? That a listing agent is selling something to their client from someone else. But if they can't do that confidently, why would the seller be willing to move forward and lock themselves into a 30, 15, 25, whatever that contract period is, 25-day contract? I wouldn't do it. I wouldn't feel confident as a seller. So we have to be buttoned up, and we have to, for our reputation's sake, be able to say this is going to work, barring any surprises. In its current state, this is going to work. And that's what the pre-approval does for you.
Right.
Yeah.
Love it. All right, moving on here. Number 5, not considering first-time home buyer programs. Now, this is kind of a broad category, as you would probably agree. There's a lot of people think FHA is a first-time buyer program, when in fact that you don't have to be a first-time buyer to use FHA. We both know that. But like, what do you think that they're referring to in this way? And like, what should they consider? I'm a first-time buyer. What's available to me?
Yep. I think this gets back into be more prepared, be more educated. There are some things that everyone will qualify for as a first-time buyer, like the ability to put 3% down on a conventional loan. That if my income is under a certain limit on a conventional loan as a first-time buyer, I'm going to get better pricing.
Wait, but Dylan, I thought 3% down was only available for FHA.
Turns out you got to put more down for FHA. So 3.5% down. There we go. So that's another misconception. FHA is not just a first-time home buyer program. You can put 3.5% down every 12 months for the rest of your life if you play it correctly with FHA. But where I think this really requires a professional is for someone that needs help qualifying is often where we really dig into more fringe benefits of first-time home buying, like down payment assistance, which vary from state to state. And some down payment assistance is pretty advantageous. Some of it isn't. Some of it can actually hurt you depending on your buyer profile. So getting with a professional that has a full sense of your state specifically and federally, what first-time buyer down payment assistance programs there are, what grants are available in different metro areas. We did a lot of loans earlier this year for a really awesome grant program in Denver. So
those were like free. That was free money.
It was free money, and that was an awesome
available to relatively high income earners as well. It was incredible.
Yeah, and that's another thing too, is a lot of people think, oh, I make $150K, I can't get down payment assistance to pay or help pay for my closing costs. There are programs with no income restrictions for down payment assistance. So if it's something where that person deserves it, it's something that your lender should bring up.
Sure.
If you are a person where you would have to deplete all your funds to buy that house, down payment assistance is probably great for you. If you have 20% down, you're going to get a worse deal if you use down payment assistance. So knowing how to navigate that correctly is important, but you should ask the question. Like for me specifically, is down payment assistance good? And then you get the information to decide that and agree upon that with the person you're working with. And that's really powerful. Mm-hmm. It's not always good. It's not always the thing to do, but oftentimes it's the actual thing that allows people to buy a house 2, 3, 4 years earlier. But it is going to vary for every single metro, every single state, every single, buyer personality. Yeah.
And it is a vast landscape too, that requires constant education and being aware of, hey, what programs are available and different times of year, different things pop up. Funds are made available and then retracted or they run out. So some of these are timely. Some of these are finite in terms of like the grants that are available. Yeah. So the ever-changing landscape is something that you've taught me.
Yeah, I think a big example there is doctor loans have changed a lot since the interest rate market has changed a lot in the past year and a half. A lot of banks don't do these really advantageous 0% down, no mortgage insurance doctor loans anymore. But there are some out there that do. And it's my job to know what those are, even if I can't do them.
Yeah.
And if it's better for you to use that, I should tell you that, hey, this is something you should research. I shouldn't just chase the money for myself. I should be able to say, hey, you're a first-time buyer, you're a doctor. Why don't you go talk to this guy I know at this bank, and I'm going to get nothing for this because it's better for you. Yeah. And hey, call me when you refinance.
and I can say too that you have told clients of mine, hey, actually, this is a deal that like you should not walk away from, and when it wasn't actually your deal. So kudos to you for having the integrity to actually say those types of things. It doesn't happen often, I should mention. Usually it's the best in town, but you're not afraid to walk away from that, which gives me confidence that the folks that I'm sending your way are truly going to be well taken care of. So, I just got to give you kudos for that.
Yeah. The pie is large. We can all find pieces of it.
The pie is large. Cool. So number 6, we have failing to check your credit score. This is an interesting one because everybody thinks that their Credit Karma score is exactly what their credit score is, which we all know can be a bit flawed. But failing to check your credit score is, again, this is something that they get wrong about a mortgage today. What's meant by that?
Yeah, I'm not sure I agree with Realtor.com on this one quite in the way that they worded it. So I think people are always on their Amex or whatever app looking at their credit score, and they think they know what their credit score is or their Credit Karma. Yeah. So I don't, at least in the people that I interact with, I think most everybody thinks they know what their credit score is roughly. I had somebody earlier this week I got on the phone with, and he was really nervous because his Credit Karma said he had a 660. I was like, hey, let's just do a soft credit pool and look at it. Because you're telling me things that don't indicate you would have a really low credit score. His credit score is 750. So it goes the other direction too. They'll be like, I have a 780 and it's 720 because their credit history is really short. Sure. So these are not reliable models. The only thing you can really rely on is a credit pool. Work with a lender, ask for a soft credit pool. You will get the most accurate actual FICO, the ones that we all use, and it won't affect your credit at all if we do a soft credit pool. So I think that's really important.
That's a huge ask, by the way.
It starts the process. Like, to get there, you're going to be able to have a couple conversations and build a base of what you think is possible. And you're going to truly know where you stand as far as your liabilities and credit are. And that's really powerful, because then you can put a plan together, because people in my shoes should also be giving advice on how to accurately navigate credit if it's something you need to improve and you get surprised by. So get a soft credit pull.
Yeah.
It doesn't do anything for you. It can only help you.
It's not a perfect analogy here that I'm about to make, but the Credit Karma, monitoring of credit is kind of like the Zestimate for people's home values.
It's really good.
Well, my home says it's worth $850K. And it's like, right. But that's because 3 of the houses that just sold near you have been completely updated from ceiling to floor. And your house hasn't been updated since the 70s. So do you think that might impact the value? And it's like, oh, okay. And most people, obviously they have a brain and they can think about that, but it seems kind of
and Credit Karma didn't see that you missed a car payment 3 years ago. That's going to have an effect.
For sure.
So
hopefully in a positive way that they miss it instead of a negative.
Yeah, potentially. But you should at least talk to a professional, and there's often ways to fix those things, but you can't know until you actually look at what the truth is.
Sure. Cool. Love it.
All right.
Number 7, picking the wrong type of loan. This is, I don't know if ChatGPT wrote this article for Realtor.com, but I don't know of a situation where somebody could get a VA loan incorrectly.
No.
But
that would be
that's very common. I got the wrong loan. Dang it.
I will say, I do think this is not totally uncommon. And let's take VA out of it, because VA is like, you need to be a veteran. Like, sorry, you didn't serve in the military, I'm not going to give you a VA loan. But USDA around Colorado, a lot of people think we don't have much USDA land. You have to sit within a specific zip code. It has to be rural. Northeast of Denver, there's a lot of USDA territory where it might be advantageous for some people. That's pretty rare. I think the bigger one is FHA here, though.
Sure.
There are a lot of lenders going out there right now because FHA has lower interest rates, and they're saying this is the play. Lower interest rates. Mortgage insurance is similar. Excuse me. Mortgage insurance is similar. You can get a lower payment with FHA. This is the play. Talk to me. I'm going to get you the lowest payment. Mm-hmm. What they're not accurately describing is that FHA tax on a 1.75% fee to your loan amount. You effectively lose 1.75% of your equity on day one. I think that's the only way to look at it. So if you're not in a position where you have to put minimum down and you have to get that monthly payment as low as possible to qualify, oftentimes it's actually better to take a conventional loan.
Sure.
With maybe even slightly higher monthly payment, because the rate's slightly higher, but you don't sacrifice 1 3/4% of your equity on day one. That's going to have implications on your mortgage insurance down the line, your ability to refinance. So this does happen. It's pretty uncommon. A good lender is going to tell you the ins and outs and the pros and cons of each.
Right.
You're going to be able to come to a decision. But I'm generally saying if you've got more than 5% down and you're well qualified, conventional almost always makes more sense from an equity position and from a future protecting of the loan and your ability to have options in the future. So
that's awesome.
But some people, it just doesn't matter. Their credit tells them what they can qualify for, or their income. So
you have educated me and some clients, of course, hey, FHA is easier in many ways, but here are the downsides. But I did not know until right now about that 1.75% of the loan amount as a fee.
Yeah, it's called upfront mortgage insurance. It's it's tacked onto the loan.
Yep.
It's paid out when you refinance, basically, or sell the house. I mean, it's always going to eventually get paid to the FHA. It's a beautiful thing. I don't think it's a bad thing, honestly, but it's something that the buyer should understand. It ultimately funds this program and allows FHA to offer loans to people that often can't qualify otherwise.
Right.
So it's fueling something that's allowing homeownership. That's beautiful. Mm-hmm. But it needs to be recognized, and it's not always the lowest payment wins.
Sure.
If it's at the expense of a large chunk of your equity, and the options are similar. So I think you should, if you get an FHA loan and you get to the closing table and you don't really understand upfront mortgage insurance, someone's done you a disservice.
Totally. Yeah. That is why doing the upfront work really makes a difference there. No question. Number 8 says underestimating fees beyond the down payment. And that is something that not a lot of people realize, that there are other closing costs in addition to the down payment of a house, right? So, I'm putting 20% down and that's it. Yeah. I mean, what do you have to say about that?
Another reason to talk to someone early and truly plan.
Yeah.
So I often have people come to me, and the first conversation is, I have $70K to put down.
Mm-hmm.
My first question every single time is that $70K for down payment, or is that $70K all that you want to spend on purchasing this house?
All of our money to get into this house.
For sure. Exactly. Is that your max spend? And
yeah, oftentimes
it's like this epiphany moment for people where they look confused for a second. They're like, wait, what? Right. So, and they're like, actually, I have $70K total. And then I get to have a conversation and an education moment of, okay, well, if we're thinking this is a $500,000 house, we're probably in Colorado expecting 2 to 2.5% closing costs on top of that. So now we can back into what your down payment truly is.
Sure.
It's probably closer to 60, right? So that also opens up the conversation of, hey, why don't we break the numbers down? Because if you don't know the answer to that, you didn't know that that was a thing, you have no reason to know what closing costs are.
Yep.
And you need to be able to walk into a house and truly know what it's going to take to buy that house before you ever step into it. So let's do the work. Let's be really honest and open. And you should know down to a very small margin what it's truly going to look like before you ever offer on a house.
Right. That is hugely beneficial up front. And I have been telling folks, hey, like you're probably going to pay between 1% and 2% of the purchase price in closing costs is what the estimate I usually give. You mentioned 2.5. Should I be adjusting that actually for my folks and saying like, hey, could go by 2.5?
I think 1.5 to 2.5 is more common these days.
Sure.
Based on our average purchase price.
Yeah.
And largely also around, because rates are high, in a lot of cases, it does make sense to buy your rate down a little bit lower, which increases closing costs. We're seeing that more often now than we saw it when rates were in the 3s. So I think that's important. There's value to spending a little bit more at closing sometimes, not always. So I like to say 1.5 to 2.5 or 2 to 2.5, depending on the purchase price and the down payment.
So then that means like on a $600,000 house, 1.5% is $9K, 2.5 is $15K.
Yeah, I think that's a fantastic range.
Yep.
I mean, just off the top, depending on the type of year, your insurance and taxes could be 4.5 of that, 5 of that. So, and then there's everything. Yeah, but ultimately, you should just know what the levers are. Yeah, it's a big range. It's going to depend. For every person, it's going to be a little bit different.
Yep.
But look at it. Know what it looks like.
Yeah. Be aware. Understand all the factors.
Yeah.
This next one, you and I think we really have this dialed in. Not being prepared for the possibility of a low appraisal. So to kick this off, I mean, I find it so valuable, especially in a market where, like Denver, we have had to make offers that were probably right around the maximum amount that a home is likely to appraise for over the last few years. So I have worked very hard to get as good as I can by taking appraiser classes. I'm not a licensed appraiser for the record, but I want to know how an appraiser thinks. So I always want to give my clients the most narrow window as possible of where likely to appraise. And, but also coming from you, do you want to define what an appraisal is?
Yeah, it's most important for the lender. So we have to order a third-party appraisal. So an independent third party, I do not know who the appraiser is, to go out and justify the price that we're offering for this house. Mm-hmm. Ultimately, it's a liability thing. Yep. The bank cannot lend on a value higher, lower than what, or higher than what that home is actually worth. Totally. So if the bank was to lend $500K on a house that appraised for $450, we have this $50,000 gap that could bite us.
Yep.
And no bank is going to take on that risk. So because of that, it protects the buyer in these days where things are less competitive, which is great. It is a buyer protection is what it was built for in the first place, to not overpay for a home. In different markets, it becomes a little scary. So if I'm, for example, in the past in Denver, we would often waive our ability to object to an appraisal. So again, let's say the house is $500K, appraisal comes in at $480. I need to be prepared for what my financials are going to look like if I need to cover that gap. An appraisal gap is what we call that. And oftentimes it doesn't actually change the monthly payment or the out-of-pocket cost for the buyer, depending on what they're putting down.
Yep.
It also stuns people to hear that sometimes.
Yeah, exactly.
Exactly. We can just move the money around. But for some people, they need to be very, very, very careful with that.
Yeah.
So we need to have that conversation. We need to look at the house. And I think something you do very well is give a very honest representation of what you think it will appraise for, not based on the Zillow's estimate, but more so on what are the recent comps in the last 6 to 12 months? How can we justify this? If it comes back low, what can we bring to the appraiser to try and push their valuation up, which is possible.
Yeah.
So you need to, if your agent is not giving you what we call a competitive market analysis of that house before you go and offer something that maybe seems like it's on the line, pushing the value of the home, you probably aren't being served correctly. And if your lender is not showing you, hey, if this does surprise us and the appraisal comes back low, what is our plan?
Yep.
And you're probably not being served correctly.
That is so true. And in a hyper-competitive market, it's more common to have appraisal coverage, obviously. But in a market that is a little bit cooler, there's a chance that in the situation the home appraises below the offer amount, you will just go to the seller and say, hey, I'm sorry, we wanted to give you this and we were prepared to give you this, but we can no longer get a loan for this amount. Therefore, here is our new number.
Yeah.
And we sign an amendment and we proceed as planned. Is typically
which it actually, right now when you're protected, it helps the buyer most often.
Absolutely right. Cool.
All right.
And last but not least, Realtor.com says, if you're not shopping around for the right lender, that could be a miss. I agree with this. What do you think?
Yeah, I totally agree. I don't think you should talk to one person in the same way that I don't think you should talk to one financial advisor before you make a decision.
Or one realtor. Or
one realtor, or literally anything in your life that's affecting your finances. You should probably talk to more than one person. And I really like the way that they talked about this in the article. They put it more around somebody that you trust, someone that is reliable. Ultimately, we're playing in the same market. People can be competitive on things like price, but for a lender, I'm not doing my job correctly if you don't walk away from an hour of time with me more confident, more comfortable, more intelligent about mortgages than 90% of your friends, and without the ability to walk into a house and know that this is going to work before you ever step foot in it.
Yep.
Some lenders are going to give you that. I work with a ton of great people at my company that I would trust doing my loan. And I've met plenty of people that I wouldn't trust, and I would rather pay more to work with someone else.
Sure.
Because it's a scary decision. It's often the biggest purchase we've ever made in our lives, the largest amount of money we're pushing out at one time to buy this house. I want to know that every stone has been uncovered, and I want a person that I'm going to trust to uncover those stones personally when I get my own loans. And I want a person that's going to stick with me for a long time, because I don't think that real estate is a one and done event for most people. I want somebody that's going to work with me and help me build wealth over the long term. And I think that you should get that from that person in the first 30 minutes to 1 hour. You're going to know if they're truly looking out for your best intention and not theirs, and not just chasing money.
Right.
And if you feel really trustworthy and you can call that person on a Sunday because you need to make an offer on that house you just walked into, and they're going to take time away from their lives and do that for you, I think that's the lender you should work with. So I think it's very important. I don't want people to often just talk to me, because we're going to have a better relationship if they talk to me and talk to someone else and come back to me and realize that I was the right fit versus just guessing.
Sure. Absolutely right. I couldn't agree more. Well, dude, thank you for walking through all of this with me here. These are a lot of questions that I'm sure some of these questions, I'm sure some people are like, yep, I had that question as well. And others maybe like, I didn't really think about loan types or some of the other things that we discussed here. Anything else? Any other closing thoughts before we wrap up today?
No, I mean, give me a shout. I'll tell you how to win in this market.
Oh, win
That's
with
the big
data.
thing.
All right.
Yeah. Know how to take advantage of the market. Get somebody that can help you do that.
100%. Well, Dylan McCatherine, Spire Financial, Denver, Colorado. Thank you for your time, my friend. It's always a pleasure.
Yeah, thanks.
And we'll talk soon.
All right. Bye.
Thank you.